Look, I think there's a number of things going on here. In fact, iSelect shares are down 47% in the year to date, and that's not including today's reaction in the shares. So when you say decimated, this is a stock that was trading at about $2 a year ago, and now we're seeing it absolutely dismal. And look, when in the last 12 months, you've had a new chief operating officer start, a new financial officer start, a new chief experience officer start, a new chief marketing officer, and now a new CEO MD that needs to be found. I guess it does signal that the company is trying very hard to turn around, but obviously there are some problems there. Look, I think there are a few things happening. If you have a look at iSelect's business, what it is it's a comparison website. And in terms of some of the products, there are some structural changes that are occurring, and the big area is health. And I know, Nadine, on this channel, we've been talking about private health insurance, in fact, the numbers being down and the impact that has in terms of private hospitals. But of course, in terms of a comparison website for health insurance as well, there would be an impact there. So structurally, we're seeing that. In terms of the consumer experience, it doesn't take too long to find that there are a lot of disgruntled customers. And I guess if you're going to this website for information and you end up being called maybe 5 or 6 times to try and lock you into a product and lock in that commission, that gets pretty annoying as well. And then of course, you've got that profit downgrade flowing through today as well. So earnings expected to come in at $8 to $12 million, which is a far cry from their previous guidance, which was $26 to $29 million. With Kogan, not only do we see a big fall in terms of the share price and a big movement in terms of share price, but volumes going through this stock were through the roof. And the last time we saw this amount of volume going through Kogan was actually on the 22nd of February, and this is when it came out with its half-year numbers. And on that day, the stock was up about 17%. Today, we're seeing it down about 17%. And I guess it's the opposite performance from the last big volume day. You mentioned the negative free cash flow, that negative operating cash flow that we've seen there of $635 million. Now, Kogan's saying that's because of the trade payable cycle and that it is customary this time of the year after a very important period like the Christmas period for that to occur. But I think the bigger question mark from the market is coming through from its growth. Now, receipt from customers is $108 million. Now, that's a pretty good number. The first half we saw $205 million, but there's not a huge amount of growth there quarter to quarter or compared to the first half. And on a stock that's got a PE ratio of 65 times, the market is expecting to see an upgrade cycle to be in play. In 2017, this is a company that saw 3 profit upgrades. Now, just in the last 3 months, the stock's up about 42%. And in 2018, we've seen no profit upgrades so far. So look, I guess a bit of cautiousness given that I think there's some expectations around the growth numbers and profit upgrades constantly flowing through, and we just didn't see that. In fact, just a bit of nervousness. And look, this was a day when growth was sold off. We saw some of those high growth names, momentum plays being sold off, A2 Milk, Bellamy's, and Altium, and some of those tech names all seeing some pretty big falls on the market. I don't know if you've walked into a House of Fraser shop. I have. It's very traditional. You know, you can go and buy jewelry or you can go buy Gucci shoes, which I think I did in Scotland when I was there, but it is a very traditional type of retail layout. So I guess you've nailed it on the head, Nadine, on whether this is about a turnaround or whether this is about a sale. And if it is about a turnaround, look, it's going to be pretty difficult because turnarounds cost money, and quite frankly, I think Myer's turnaround may be held back by the debt covenants that it has. It's refinancing of about $420 million that needs to be done. That expires in August 19. And I think the biggest challenge for a CEO would be trying to get the size of Myer down. So it's almost maybe a hedge cutter role that he's applied for, where you're not only reducing the number of stores, but you're reducing significantly the floor space. And I guess one of the biggest costs for Myer is the large rents that it pays and also the long leases that it's locked into, typically around about 13 years. And then you've got the increase in competition by some of the online players or Amazon. So essentially, I think his job is either going to be to really trim the company down to size, stay within those debt covenants, and be able to, I guess, try and get the balance sheet in a better position and turn it into a smaller, more sustainable play, or number 2, try and angle for a sale.